Well, Miss Catherine, if I know any looking in the mountains, you'll be my go-to girl.
Very good. Anytime.
Okay, Miss Laura, you are all set.
Okay, let me share my screen. Good morning, everybody. I am Laura Huckaby with Old Republic Exchange, and I am happy to join you all today, and I expect this is probably a topic of interest because stories just being discussed how there's low inventory and a lot of activity with investors. And so 1031 exchange has certainly been a big, a popular thing here recently. Okay, so let me see. Are you able to see my slides? Assuming you can see my slideshow here, right?
Yes.
Okay, perfect. All right. Well, I'm located in Charlotte, North Carolina. I've been with our company about 16 years. I manage operations as well as do sales. So I have heard and seen stories of all kinds of every type of exchange, you know, whether it's residential, commercial, land. So I'll be sure to leave time at the end in case there are questions, if that's something you all want to have the opportunity to do. But first, let's just jump into what is a 1031 exchange. Well, the kind of screen here shows you it's a technical term that comes from the tax code. We all know tax code is not the simplest, but this is just one section of the code, and it is specifically geared towards investment or business property. So in other words, any property being sold that has gain that's either been held for investment for some length of time or used in a trade or business could be exchanged. So essentially what that means is it's not for primary residence, but obviously there's a different section of the code that excludes gain for primary residence. But what the 1031 exchange allows is deferral of paying capital gains taxes as long as another investment or business property is acquired within the 180-day period. So the exchange period is 6 months, and within that 6-month frame, the replacement property, or in some cases properties, because you can buy more than one, has to be identified within 45 days. And so one just little history I'll point out, the code that we use today was adopted, this safe harbor was adopted in 1991. So it's been around a long time, and that's why it may seem a little antiquated when we talk about these deadlines that, you know, the IRS doesn't really make adjustments for current market conditions. And so that's been something, particularly getting through this pandemic. You know, it's a common question to me. Can I ask for an extension? Do I get more time? And unfortunately, the answer is no. It's not like with filing a tax return where they allow the opportunity to ask for an extension. So as agents, you know, working with investor clients, it's very important to know up front that these deadlines are hard and fast. So from the point you might be working with somebody who's selling an investment property or, you know, something that fits this criteria with gain, you probably want to already be talking to them about finding the replacement. And that can be found even up front before the sale transaction has occurred. So what is capital gain? This is often a misunderstood term. Or how it relates to what the tax would be paid upon. So gain is essentially the difference in the original price one paid for the investment property versus the price they might be selling it for today. Now, there are a couple more little important parts of that equation, and that would be depreciation. So depreciation, if someone has owned a property for years and years, is usually something they take annually, and it's a write-off. So what that's doing is actually increasing their gain in the end because they've been taking a little bit off each year while they've owned the property. The other component is improvements. So if during the duration of ownership of an investment or business property, they've made substantial capital improvements, maybe put on a new roof or, redone the interior, whatever the case may be, anything that's going to prolong the life of the property or improve its value, that is increasing the basis, which means actually that's decreasing what the ultimate gain calculation would be. So again, if you're taking notes, the exact calculation is the original price someone paid for a property when they bought it, minus the depreciation they've taken while they've owned it, plus cost of any improvements they've put back into the property. So that's how the adjusted basis is determined. And then that number would be subtracted from what the list price might be today. And whatever the difference is therefore the gain. And that's what the gain, or that's what the tax is paid on, is that gain. So a couple things, the reason this is a bit of a misconception to people. They usually get their closing statement and look at the bottom line and think whatever they're walking away with is their gain. But obviously, in me just describing to you how gain is calculated from an accounting standpoint, excuse me, that bottom line figure is not always true. One good, clear example of how that would play out is somebody could have refinanced their property to leverage the equity while they owned it. So there could be a very large loan being paid off, and therefore their bottom line that they're walking away with could appear to be quite small. But that still doesn't equal to what the gain is, because again, you heard that definition of how I explained you get the gain, and it didn't account for a loan. So the gain is not at all based upon any loan being paid off. So it's important to know these things in looking at, values of property when you're discussing it with clients. Really just, I think as agents, the key takeaway is to ask them what they paid for it originally. If they've owned it, more than a couple years, it's probably safe to assume they could be a candidate for this if they've got plans to continue owning real estate and potentially buy, another property. So here are just some basic terms. I may have already used a few of these, but I will as we go on. Relinquish just means the one given up. So that's the one that has the gain. Replacement means the new one being acquired to replace the old. The identification period I alluded to, that's 45 days. That's the length of time to identify in writing the potential replacement properties. I will pause here if you're taking notes and say it's not required to have a contract within the 45-day period. Identification is again as simple as in writing a list of clearly described properties and delivered to a non-disqualified party, which we'll dig a little deeper into identification here shortly. The exchange period is the full length of the time from the sale to the buy, which is 180 days or 6 months. And again, I would like to point out that both the 45-day and the 180-day period, which run concurrently, start from the date of closing on the relinquished property. Closing being the key word. Some people have the notion it's when they sign a contract. It's the date of close on the property disposed that starts the clock on these dates. The last definition here or term is just related to when the taxpayer can and can't access their money during the exchange. And that's basically really what one of our sole purposes or role is under the code, is that the taxpayer cannot access, control their funds during this exchange period. So they're restricted as to when they can, and basically limited to only using those proceeds towards the purchase of replacement property or for the deposit, earnest money deposit of a replacement property. But essentially what this means is someone can't call us on day 30 into their exchange and decide they want to go buy a new car with some of these proceeds. The funds are a little more locked down than that. Under the code, once sales occurred, we're holding the funds. We have to keep the funds safe and can only use those towards the purchase of real estate. So why do people do this? Well, the first one is rather obvious. Capital gains are pretty substantial. And so it's a great tool to defer that. So let me just give you a little bit of an example. The federal rate is anywhere between 15 or 20 for long-term gain. And then there's the Affordable Care Act that added 3.8% to most investment transactions. So you figure the blended rate there is usually going to be either 18.8, or for the top tax bracket, that would be 23.8. And again, that's only federal. Most states also have state capital gains taxes. So if you think someone even just had $100,000 in on a transaction, that's potentially, $18,000, $19,000 immediately going to be paid to the government for the sale of that property. So in doing the exchange, that $18,000 or $20,000 is a down payment on another replacement property. So taking those dollars that would be handed over and paid tax and leverage it to put it towards another property. It's often used to diversify. So if people own multiple properties, they might want to exchange out of, say, single families and roll maybe 2 or 3 rental properties into a commercial property. Or maybe it's to location. We see often people might own property in, college towns and then decide, okay, we're ready to move away from that area and want to move it to a different location, maybe a vacation rental scenario. And, just passive investment like land, farmland, or just.
Hey, Laura, excuse me.
Yes.
This is Wendell. There's some folks with their microphones on, and it's
Okay.
making it very difficult to hear Laura. So if everybody will check your mics and mute them, please.
Thanks. Appreciate you pointing that out. So I was just mentioning another example would be going from like farmland or just land that's been owned, and then it is you turned into a more income producing type property, to collect rents and whatnot. So a variety of reasons, as you can see, but all, essentially to continue to build wealth and long-term strategy and holding real estate without, paying a whole lot of taxes along the way. So what qualifies? Well, this again, I would say is one of the more common misconceptions. A lot of people just hear about it and hear like kind and think, oh, well, if I sell a condo, I'm going to have to buy a condo. But that's actually untrue. The definition is broad. The code essentially says any type of real estate, real property that's held for investment. So that means different types of property with, essentially different characteristics are interchangeable. So here's just a few examples, like could go from a single family rental to multifamily or land to retail. So, you all, I'm sure, are well aware of the exclusion for primary residence that I kind of referred to earlier, which allows anybody single to exclude up to 250 or married up to 500 on a primary residence. So I think it's clear, again, just to put some numbers to it, to think in terms if, somebody bought their primary residence for 100,000, sold it for 175, then they exclude that 75. Great benefit, great perk. But with investment property with those same numbers, if they bought for 100 and sold for 175, every single dollar of that 75 that they gain is taxable. So, just puts into perspective the difference and why this code is useful in helping people to go from different types of property and again, continue to own real estate without having to pay the huge tax burden along the way. So this slide sort of just defines what the rules are, because there are, of course, some technicalities and things that have to be followed. So I'm just going to kind of go through them and kind of give you some practical tips. We've obviously touched on one, that the property has to be sold and purchased, has to be investment property, business use property, not primary. The one little point or takeaway I would say here is to consider second homes, vacation homes. Those used to be a very gray area, but the IRS did give clarity. It's been about 12 years ago, but they did give a safe harbor for second homes, meaning they say if you fit this criteria, it's considered still investment and could be exchanged. And the basic qualification there is that it's going to be like an Airbnb, for example. It's going to be rented at least 2 weeks out of the calendar year, and that has to be for the first 2 years that it's owned. The other criteria is that the taxpayer is supposed to only use it 2 weeks out of each calendar year for the first 2 years. They say, or 10% of the days that it's rented. So again, in our common Airbnb example that we would see commonly, maybe mountains, coast, wherever, if somebody's able to rent it pretty heavily during the good seasons, and let's say they end up renting it 300 days out of the year, then 10% of that would be 30 days. So then their personal use that year, they could use it 30 days. And again, that's for the 2 years of ownership. After 2 years, basically it's no requirement to follow those same rules. So I think particularly in our state of North Carolina, we have a lot of opportunity for vacation, second home type rentals, and it's a great advantage that people can use it some. It can be their own personal vacation rental for themselves, but also considered investment and have the ability to exchange it. Secondly, you have to use a qualified intermediary. That is what my company, Old Republic Exchange, is, but it's basically a third party that has to step in and be involved in the transaction. We're essentially stepping in the shoes of the taxpayer, kind of being assigned in. We don't actually go on title or deed to the property. We're just stepping in to receive the proceeds when the relinquished property sale closes. And then we're going to hold those proceeds and step back in the shoes of the taxpayer to sort of act like the buyer to deliver their proceeds when they are ready to close on the identified property. So the third party must be used to effectuate an exchange. And that segues right into number 3, that the exchanger or taxpayer cannot have actual or constructive receipt of the proceeds. So that goes back to where I defined what the G6 restrictions are. The taxpayer can't control their funds. They have to be in possession of the third party, us, the qualified intermediary between the sell and the buy. An exchange agreement must be entered into before the date of the relinquished property closing. That's a key point. The exchange agreement is like the contract between the taxpayer and the qualified intermediary, the third party. So that has to be in place by the date they close, not after. I've had so many disappointed folks who call me 2 days or a week, even 2 weeks later. And often the story is, I've not cashed the check from closing. Can I still do an exchange? I just realized how much the taxes are going to be. Well, unfortunately, no, because the safe harbor here tells us for it to be valid, it's not only just not taking possession of the funds, but having entered into this exchange agreement with the qualified intermediary by the date of close. So if you are working with a seller with investment property, please be sure to ask them before closing is finished if they are considering an exchange and would need to engage the service of a qualified intermediary to do so. The 5th rule here is that the taxpayer must identify in writing. That's the identification they have to do in 45 days. I'll just make a quick point here that it's not an email to us. It does have to be in writing. So a format that is signed and dated. And we do provide that form. Again, current market trends, most often we're seeing people have already entered into their purchase agreement. They're probably even closing within their 45-day period. So that's kind of commonly what's happening, but there have been points in time with, real estate activity that they're identifying and not going to be closing for 90 or 100 days in that 180-day period. So identification is a really key element. And then lastly, the taxpayer must complete the purchase of one or more of those identified properties within the 180-day period. So they have to actually close. Again, closing is what completes the exchange. Just to put a few finer points on the rules of identification, the most common is the 3 property rule. That allows 3 properties of any value to be identified. So let's give an example. If somebody sells for $500,000, they need to buy a property of equivalent or greater value to defer all gain. So $500,000, they could identify up to 3 options, all 500, $1 million, let's get crazy, 10 million, doesn't matter. As long as they only list 3, they could buy any combination of those 3. The secondary rule that we do see used pretty often is the 200% rule. So the big difference between the 3 property and the 200% rule are that you'd be identifying more than 3. So be trying to identify 4, 5, 6, 8, 10. But the kind of limitation or cap on this rule is value-based. Can only identify up to 2 times the value sold. So in my example, the taxpayer sells for $500,000. 2 times 500,000 is $1 million. So they could identify any number of properties that collectively the total fair market value would not exceed $1 million. And so the question might be here, well, why? Why would they do that? This is usually when someone goes from that $500,000 house or let's say commercial property and decides, I want to have 3 condos to rent. And they're all going to be in the price point of about $250,000. So this would be when they could identify up to $1 million. They could list more than 3. If they could list about 4 in my example of $250,000 price range, and then decide amongst those 4, okay, which 2 am I going to buy or 3? So that's kind of why the 200% rule would be used versus the 3 property rule. But again, I would say vast majority of the time, the 3 property rule is used. 95% is an exception. So I'm not even going to spend much time going over it because it's restricted in the sense that there's no limit on the number. There's no limit really on the value, but the taxpayer has to acquire 95% of what they identified, which just isn't very practical. I think in my 16 years of doing this, I've seen it used twice, and it was a situation where it was a farmer putting together multiple parcels to farm on and had already closed on like 9 of the 10 parcels within the 45 days and just had to add the 10th because it was going to close outside the 45 days. And so that's where the 95% exception did work, but it's rare. Here's just a timeline, a visual to show what the deadlines are, or when it starts, when it ends, and where the 45 days falls in between. These are calendar days, so that's important to note. If you're ever working with somebody whose 45th deadline falls on, Christmas, unfortunately, that's still the deadline. So we have to do some advanced planning there and remind people, but it is calendar days, not business days, that these deadlines fall on. This is probably one of the top questions I receive, and you all probably encounter it often too, because in times like these where real estate's turning, flipping is rather popular. It's, also lucrative, but flipping is different than 1031. And so you see here on the slide, qualified use. That's the term we've extracted from the code. qualified use is how they define the difference or kind of give this broader definition of what meets the 1031 criteria to be exchange eligible. So there's no exact timestamp. I've heard everything. People are so convinced it's 1 year, it's 2 years. Not true. There is no defined time under the Treasury regulations. That's the fact. But with that said, most tax practitioners are going to tell people that it should be probably greater than a year. Why? Well, capital gains go from short term to long term after 1 year. A lot of people recommend at least 2 years. Why? Because there's several private letter rulings and court cases where the IRS has alluded to 2 years being satisfactory, particularly in scenarios where it's family transactions. They kind of come back to this 2-year idea. So this is where the notion of a year or two typically comes from. But as you can see here, on the slide, I've cited 2 different court cases, and basically there was one where an exchange was successful after only 4 months. Well, that sort of then makes us think, she's saying we can't do flips, but different facts and circumstances. So think of it as a 3-prong scenario for qualification. It is length of time that does play in, but then also intent. The key here about qualified use is intent with the property while it was owned, and for the taxpayer's intent to be there to hold it long term. Circumstances, what changed? So think of like a flip that would be bought to fix up to immediately sell. So intent with that from day one is never to own it, rent it, hold it. It's to fix it, sell it, make a profit. So it's going to be a short period. It's going to not intend to be held, and circumstances are it's back on the market for sale in a pretty short period after it was acquired. So there are some circumstances where people have had at least, have intended to hold it, and have unsolicited offers come along, and that's where the IRS has upheld exchanges that were for property owned short periods. Likewise, we always highlight this just because, again, I want to illustrate and make the point. There's no magical time period. There was an exchange that failed where property was held for 6 years, but the court just basically determined the intent was never there. It was bought really to sell. It just so happened that they held it for a longer period before the sale ended up occurring. So it's kind of frustrating to people that there's not a little more clarity about the time, but it is, all of those 3 things: intent, circumstances, and time. So trying to wrap it up here because I don't want to take too much of your time, but the benefits, we've really sort of already gone down the list, but defer those capital gains taxes, roll it into more property. It's leverage for wealth building. The only thing I'll kind of add here is that it's been a long-term strategy of estate planning that people can continue to hold real estate ultimately until the time of death, because then it passes to heirs, meaning the people who inherit it get it at the value when they receive it. So that's kind of the ultimate way that the tax bill goes away. Obviously, there's no guarantee that this will stick forever, but it has been for a long time, and a lot of people have used it for, this purpose for estate planning. Relocation of assets, and then estate planning, as I just mentioned. So what we do, we're the third party, we're the qualified intermediary. Our role is really to kind of stay between the lines, follow the rules, be compliant with the regs. So we prepare all of the documents to do that. That exchange agreement I mentioned, an assignment agreement, which is how we step in. And then we do a lot of consulting between, agents, attorneys, CPAs, making sure everybody's on board, knows the timelines. And then we do actually execute closing documents, the closing statement. So again, that's why it's important to get us involved sooner than later when somebody's going to do an exchange, so that we have instructions and people don't get frustrated having to redo closing statements and whatnot too close to the closing date. And then we hold the funds and do that so that the exchanger cannot control or receive those. And then just a lot of coordination along the way, since we're involved with multiple transactions for the taxpayer. So that is our function. And then for you as agents who often kind of help direct people to find good service providers, I think it's important to highlight really the importance of choosing a qualified intermediary wisely. You want them to be an expert and compliant with the regs so that if taxpayer is audited down the road, they don't have problems. One point that I think people sort of gloss over sometimes, but more important than what's it going to cost me is how secure are the funds? Are they going to be there when it's time for me to close on my replacement property? Because unfortunately, there has been some fraud and dishonesty in this industry. There was one fairly large size company that defaulted over 10 years ago because of the way they were placing funds in auction rate securities. They weren't keeping them liquid, and then the market kind of dropped. There have just been some crooked people. There's an episode on American Greed that highlights one company that was fraudulent, took the money. So it is important to make sure that the company is, bonded, secure. So that's why I kind of highlighted the financial strength and security of our company, that we carry 50 million in errors and omissions, 120 million in fidelity bond. It's not required to do that. That's the odd and surprising thing. This is unregulated. So anybody could technically be a QI, could technically hold the funds. The IRS, even though they have all these technicalities in the code to follow, don't have regulations for who can act as a qualified intermediary. So that's an important thing to know in steering your client toward a qualified intermediary. So here's my contact information. Obviously, you can check out our website. I've just touched on really kind of the basics. There are a lot more in-depth topics that come up. So I would say you could, check the website for articles we've published, but feel free to always just reach out by call or email to me. And I'm happy to be a resource. And I can now take questions. Yes.
I could raise my hand, but I use my little raise hand button. Can you explain more about the depreciation? I want to say that you said that depreciation will increase the capital gains and that and the improvements will decrease the gains. Is that correct?
That's correct. Because again, I'll just use simple numbers. Bought for 100,000. Let's say they've owned it 10 years and that ends up equating to maybe 20,000 in depreciation that's been taken. So that 100,000 original price would be reduced, take away the 20,000 they've taken in depreciation. So that brings it down to 80,000 as opposed to 100, what they originally paid for it. But then if they've made improvements, let's say they put on a roof, we'll just using fake numbers, but that takes it up to, let's say 90,000. So then instead of it just being that 100,000 they paid for it originally, you see how we've had to adjust that equation. We subtracted the depreciation, which brought it down. We've added back the number for improvements that sort of went back up. So in that case, that adjusted basis is 90,000. So then like if it's sold for 200,000 today, you're taking 200,000 minus 90 gives you the gain of 110.
Got it. Thank you so much.
A calculator on our website that kind of runs that you can plug in real numbers. And again, I would say don't try to be the numbers expert. We always, even myself in doing this, I still say you need to go to your accountant, because let's be honest, 9 times out of 10 people don't know how much depreciation they've taken. So it's important before really engaging in this process to sort of have them call their accountant to figure out what is their adjusted basis. Does this make sense?
So when would you suggest getting everyone together? Because I know you said that during the process, you guys coordinate with CPA, attorney, real estate agent. So when would you suggest that they start, the process? Like if they
Yeah.
come to me and they say, okay, hey, there's a property that I want to do. I want to go ahead and do the 1031 exchange.
Mhm.
And that's the point. Okay, yeah, go to your CPA and figure this out.
Yeah, I mean, if they know they're going to soon be listing, even if they've listed, if they just have a contract, I would still recommend that they run the numbers or run it by their accountant to kind of get what is a realistic number. What's the picture? Give me the analysis to understand my gain. Because another really common thing that happens is people end up partially replacing. So maybe they only buy, 3/4 as much replacement property as what they sold. And therefore that leaves money that is still taxable. So then it's looking at, okay, since I didn't fully replace it, I only partially replaced it, I'm getting a tax savings. Is it enough to still make this worthwhile? So there's all kinds of scenarios and people in my daily conversations are, does this make sense? Should I do it? And unless they do know specifically what their adjusted basis and gain is, there's really no way to analyze and give a straight answer on that.
Laura, this is Catherine.
Yeah.
I had a client that asked not long ago if they sold their property and had another property, had a contract on a property to buy, to exchange, did they still have to use the QI? If it went from one attorney directly to the other attorney and they still didn't touch it, were they still required to do that? And it is my understanding that you do.
Yes, and that's a great question. I've had attorneys ask me that question. It seems as if maybe you could avoid the use of the third party. We call that a simultaneous exchange. And so the concept here, though, is that the rules do require, the regs I've referred to, the use of the qualified intermediary in an exchange agreement. So that's what would not be in place if, even though they think I'm not touching the money because it's just gonna, my sale close in the morning, my purchase in the afternoon and flow from one attorney to the other. The other point is, though, how's it getting from one attorney to the other without the taxpayer controlling that? Because they would be telling them. And again, that's how technical that the code says it's not just about actually receiving the money, it's constructively. And so that's a point where they would be in control if they're saying, instead of giving me my check for seller proceeds to go over here and buy, just send it to this other attorney. So yes, the answer is yes, still have to use a qualified intermediary, even for a simultaneous exchange. So that we as the third party are giving that direction, controlling the flow of the funds.
Now, are your rates a flat rate or is it based on the amount of funds that come in? How do you price your,
That's a great
what
question.
you do?
So our basic rate is for any exchange that's like 500,000 or under. It's a flat rate. It is just a service fee rate. It's $950, and that's deducted at the time of closing. So we never ask people to send us a check up front. It's just they close, we get their proceeds, we deduct it from proceeds instead of even having to have a separate check cut. It's just simpler that way. And then on the second transaction on the buy side, the replacement property, we have a fee associated with that of $575. So that touches most, the vast majority of the transactions. But if we do have $1 million or $2 million, it does slide up a little bit, like to 1,200 or 1,500 if we start getting into, the millions. And again, this too, I would point out, and essentially everything we've talked about today is your traditional, what we call delayed exchange, where the sell is happening before the buy. But there is a way that you can buy before you sell, and that's a reverse exchange. That's another topic, but it's just more complex, more expensive, and that in that scenario, we do actually have to go on title because the taxpayer can't own both at the same time. And again, we're in this kind of market where we're having more of those because people know they can sell right away, but aren't sure they'll get what they want. So they want to go find their new property first, get it, buy it, and then know they can sell with no problem the old one within the 180-day period. So just know that's an option, but it is more complex in how it's structured and it's more costly. I mean, our starting fee on a reverse exchange is like $6,500. Any other questions?
I have one question. I thought Old Republic was home warranty. That's it.
Good question. Well, we are sister companies. Old Republic is a national, well, I'll just give you the big picture. Old Republic International is who all divisions of anything you've probably ever heard Old Republic roll under. So publicly traded, you could look up New York Stock Exchange, ORI. But yes, home warranty is, I don't know if you can see the logo behind me, but it probably looks similar with the stars in a circle. We are sister companies. The other, like what our parent company is, we're a national services division within Old Republic National Title. So Old Republic is one of the largest and the highest rated title insurer in the nation. It's a multi-line insurance company, so you probably have seen and heard the name frequently, but a lot of people are very familiar with home warranty. Any other questions I can answer today?
Laura, thank you so much for all of that information.
You're welcome. Thank you for having me. And I know it was a lot. So if anybody offline or just has a scenario come up, please do reach out and I'm happy to schedule a joint call or, be a resource.
I think it was very useful information and we absolutely appreciate your time.
Yeah, thank you so much. It was great information.
Thank you.
You.
All right. Well, have a great day, everybody.
You too. Thank you.
Thank you, you too.
Bye-bye.